Commodity overview and price action. Gold futures are maintaining a firm consolidation footing, with COMEX August gold trading near $4,125 per ounce as spot prices stage a decisive rebound off the key $4,000 psychological threshold. Following a sharp pullback from early-year multi-thousand-dollar record highs, physical bullion is establishing a tight institutional accumulation channel. Global ETF flows through major holding vehicles like SPDR Gold Shares, GLD, are stabilizing, indicating that institutional asset managers are rebalancing into physical hedges ahead of upcoming economic data releases. This technical consolidation near $4,100 per ounce reflects a market adjusting to sticky physical demand on one side, and central bank interest rate recalibrations on the other. To map the macro narrative for gold, we must evaluate the interplay between real bond yields and sovereign monetary reserves. As the Federal Reserve keeps benchmark interest rates in restrictive territory to manage inflation, the US dollar index, DXY, has settled near the 101 mark, keeping dollar-denominated gold prices in a defined trading band. However, when real 10-year Treasury yields experience temporary compressions during softening economic data prints, non-yielding bullion gains immediate non-fiat allocation momentum. Crucially, global central bank gold buying remains a powerful structural floor beneath the market. Institutions like the People's Bank of China continue to accumulate physical gold reserve tons month after month as part of long-term reserve diversification strategies. On the physical supply side, gold extraction is confronting a severe all-in sustaining cost, or AISC, inflation cycle. Global gold miners are managing higher labor, energy, and equipment costs alongside declining average ore grades across Tier 1 jurisdictions. Because bringing new primary gold deposits from discovery to production requires up to a decade of environmental permitting and capital expenditure, primary mine supply remains essentially inelastic. At the same time, structural physical demand across Asian markets and official sovereign vaults continues to absorb new refined bars, preventing significant downside price liquidation even during hawkish Fed rate cycles. For US equity investors, elevated spot gold above $4,000 per ounce translates into exceptional free cash flow margins for low-cost domestic miners. The premier large-cap winner in the US market is Newmont Corporation, NYSE, NEM, operating with AISC significantly below current spot levels. Every $100 expansion in realized gold prices generates hundreds of millions in additional operational cash flow for Newmont, supporting debt reduction and dividend durability. Our second key equity winner is Barrick Gold Corporation, NYSE, Gold. Barrick boasts a world-class Tier 1 asset portfolio, providing investors with strong operational leverage to spot bullion without taking on speculative single-asset mining risks. For investors who want pure physical price tracking without equity operational risk, the SPDR Gold Shares ETF, NYSE, GLD, remains the institutional benchmark for liquid gold allocation. While physical gold miners capture high real margins, an environment characterized by sticky inflation and high real yields creates capital drag elsewhere in the US stock market. Unprofitable speculative tech growth stocks face valuation multiple compression when risk-free benchmark rates remain elevated to compete with hard asset inflation hedges. Similarly, highly leveraged regional banking institutions experience deposit cost pressures as institutional capital migrates out of low-yielding cash instruments and into liquid physical safe havens or higher-yielding treasuries. Understanding where capital flees during monetary shifts allows you to avoid high debt equities that suffer when liquidity tightens. Looking at the technical chart roadmap for COMEX gold futures, $3,950 per ounce serves as primary structural support, with $4,000 acting as the key institutional floor. To the upside, a technical breakout above $4,180 opens the pathway toward the 200-day moving average resistance band near $4,340 per ounce. Over the coming week, institutional traders will monitor upcoming US CPI inflation reports, Federal Reserve speaker commentary, and monthly central bank reserve updates. Maintain a disciplined allocation strategy by utilizing technical pullbacks towards support as potential dollar cost averaging zones for Tier 1 producers like Newmont, NEM, to see how gold's macro signals link directly to our daily US stock market coverage. Subscribe to Global Macro Pulse, and we will see you in the next update.